Most people spend more than a decade in school without learning anything truly essential about managing everyday money effectively. We graduate knowing complex equations, yet remain confused about the financial decisions shaping our lives every single month. That gap leaves millions of adults learning about money the hard way through debt, fear, mistakes, and overwhelming financial pressure. That is why Max's story feels incredibly refreshing, because he proves ordinary people can quietly build extraordinary wealth. Max was never a tech founder or investment genius. He simply taught English at a regular American public high school. He earned a modest paycheck, yet still managed to retire early as a millionaire through surprisingly simple financial behavior. The rules Max followed were so boring that most people overlook them, which is exactly why they work consistently well. His first rule explains why wealth is less about numbers and far more about understanding your emotional responses during uncertainty. The hardest part of building wealth is not learning mathematics, but training your mind to stay calm during market turbulence. Imagine watching financial news in 2008 while chaotic headlines scream about collapsing markets, disappearing savings, and global panic. Your portfolio drops 40%, and your brain urgently commands you to sell everything before it supposedly becomes worthless. When markets soar again, emotions flip, pushing you to buy more at exactly the wrong possible moment near the peak. Humans evolved for survival, not investing, which makes financial fear feel real even when logic points towards staying patient. During that crash, many people sold their investments, locking in losses that permanently damaged their long-term financial future. Think of money like a tree you carefully planted and patiently nurtured through seasons until it slowly grew stronger. When a storm arrives, you panic, dig it up, drag it inside, and accidentally kill what was growing beautifully. That is exactly what many investors did during major market downturns because fear masked the truth about recovery cycles. People did not lose money simply because markets fell. They lost money because their emotional reactions caused irreversible mistakes. Psychologists call this loss aversion. Losing $1 hurts about twice as much as gaining $1 feels good. The same instinct once warned ancient humans about predators, but now it incorrectly triggers when charts display red arrows. The investors who remained calm during 2008 or added more money while prices were discounted later multiplied their wealth dramatically. Every storm eventually passes as markets recover because the financial system is structurally designed to trend upward long term. Building wealth requires mastering your emotions even when the world appears panicked, and every headline urges impulsive decisions. Max repeatedly reminded himself that staying invested was an act of discipline, patience, and long-term confidence. His second rule focuses on choosing quiet wealth instead of loud spending, which ultimately creates a more secure financial foundation. Modern culture celebrates flashy displays of status, encouraging people to buy new cars, new phones, and luxurious vacations constantly. Social media rewards people for showcasing expensive lifestyles, even when those lifestyles are funded by debt or unstable finances. Meanwhile, people who appear ordinary often accumulate substantial portfolios because they consistently prioritize investing over showing off. Max called this stealth wealth, building real financial strength without performing or seeking external validation from others. He imagined every dollar as a tiny worker. Spending sent that worker away forever, while investing put it to productive use. The more workers you send out to generate returns, the sooner they bring back enough reinforcements for financial freedom. People avoid saving because spending feels pleasurable immediately, while investing feels slow, distant, and less emotionally rewarding. Many raise their income yet allow expenses to inflate equally, trapping them in lifestyle creep without improving long-term satisfaction. Max avoided this trap by living below his means, biking to work, packing lunches, and avoiding unnecessary expensive purchases. Those choices allowed his investment workers to multiply quietly and consistently without needing sudden massive sacrifices later. His third rule harnessed compound interest, the quiet force that grows wealth exponentially after years of consistent contributions. Compounding allows money to earn small amounts, which in turn earn additional amounts, ultimately creating a snowball of growth. Warren Buffett exemplifies this principle because most of his vast fortune accumulated after decades of patient compounding. When Buffett reached age 30, he had around $1 million, which later expanded into billions through time and discipline. More than 90% of Buffett's wealth appeared after 60 because compounding accelerates rapidly during later stages. Max understood starting early mattered more than starting big because consistent growth becomes unstoppable over long timelines. Delaying investing by 10 years can dramatically reduce retirement wealth as it sacrifices years of exponential growth. His fourth rule involved using low-cost index funds instead of chasing individual stocks or high-fee investment products. Index funds act like baskets holding hundreds of companies, allowing investors to benefit from overall market performance. This strategy avoids guessing winners and instead relies on broad economic expansion that historically increases over time. Many professionally managed funds fail to outperform the market while charging investors high annual fees that erode long-term returns. Paying 1 or 2% in fees annually seems small, but compounds into devastating losses worth hundreds of thousands. Index funds typically cost extremely little, often less than 0.05%, allowing nearly all gains to remain invested. Max appreciated that low fees significantly improved compounding power and protected his portfolio from unnecessary financial drag. His fifth rule emphasized maintaining a balanced portfolio combining stocks for growth and bonds for stability during volatility. Stocks generate long-term wealth while bonds protect investors from extreme downturns that can create emotional decision-making pressure. The correct balance depends on age, goals, and personal comfort with risk, rather than a universal formula applying to everyone. Younger investors may prefer heavier stock allocations while older individuals lean towards safer, more stable bond exposure. Max diversified globally, recognizing that relying on one country's economy exposes investors to unnecessary concentrated risk. He built his portfolio using simple index funds rather than complicated products designed primarily to impress inexperienced investors. His sixth rule warned against blindly trusting financial advisors whose incentives might conflict with their clients' well-being. Many advisors earn commissions by recommending expensive products regardless of whether those products benefit clients financially. A 2% management fee can consume enormous portions of returns over decades, destroying potential wealth quietly. Max preferred fee-only advisors or self-management strategies, ensuring transparency and alignment of long-term incentives. He encouraged asking advisors how they get paid because their discomfort often reveals potential conflicts of interest. His seventh rule involved rebalancing, a practice that maintains intended risk levels by adjusting investments periodically. Rebalancing works like gently trimming a bonsai tree, keeping everything healthy without drastic or frequent changes. When stocks outperform, portfolios drift toward higher risk levels that require intentional realignment to original targets. Selling some winners and buying undervalued assets naturally enforces buying low and selling high without emotional interference. Max rebalanced only once or twice each year, enough to maintain discipline without reacting impulsively to market noise. Rebalancing strengthens long-term emotional stability because it prevents portfolios from drifting into dangerous territory unknowingly. Through these rules, Max quietly built a life defined not by luxury purchases but by genuine financial independence. True wealth is not about displaying status symbols. It is about waking up each day owning your time completely. Max believed joyful living should never disappear, so he allocated a small fund dedicated entirely to present enjoyment. Separating fund money from future money allowed him to enjoy life now while still building an extraordinary financial future. Wealth becomes meaningful when it supports freedom, security, family time, and experiences that create lasting personal fulfillment. Max understood that discipline today creates opportunities tomorrow that feel impossible without consistent, long-term financial habits. Many people think wealth requires extreme sacrifice, but Max proved small daily choices ultimately shape financial destiny. He focused on behavior rather than income because emotional discipline influences outcomes far more than paychecks do. Financial education changes everything once people understand how simple habits compound into transformative life results. Max's journey encourages others to see wealth as a slow, steady process built on patience and consistent action. His story demonstrates that ordinary people can build extraordinary financial futures when they avoid emotional financial mistakes. He believed every paycheck carried potential for freedom when directed intentionally instead of spent automatically without thought. Max's habits formed a personal roadmap showing exactly how disciplined behavior creates long-lasting financial security. Even people earning average salaries can succeed when they prioritize saving, investing, and controlling emotional impulses. Each rule reinforced the importance of focusing on long-term goals rather than chasing short-term excitement or trends. Max often reminded himself that money grows best in quiet environments where impatience cannot disrupt compounding progress. He avoided comparing himself to others, understanding that comparison encourages overspending and unnecessary financial pressure. Instead, he compared himself only to his long-term goals, ensuring each decision moved him closer to independence. Max enjoyed the peace that came from knowing his financial life was simple, automated, and resilient during uncertainty. Automating investments eliminated emotional hesitation because decisions occurred consistently without requiring constant willpower. Each contribution strengthened his compounding snowball, ensuring steady momentum even during months with difficult market conditions. Automation protected him from the temptation to time the market or react impulsively to temporary volatility. Max appreciated that predictable habits beat unpredictable emotions in nearly every long-term financial scenario imaginable. He realized success depended less on picking perfect investments and more on avoiding catastrophic emotional decisions. Fear and greed destroy wealth faster than any market downturn when investors react instead of remaining disciplined. Max learned to pause before responding to financial stress, allowing logic to override emotional impulses consistently. This simple skill prevented him from repeating mistakes that commonly trap people in cycles of loss and regret. Over time, his confidence grew as he observed his investments recover repeatedly from downturns he once feared deeply. Each recovery reinforced his belief that perseverance outperforms panic in nearly every financial situation imaginable. His calm mindset became a strategic advantage because emotional discipline is rare, while fear-driven reactions are common. Maintaining simplicity allowed Max to understand his finances clearly without becoming overwhelmed by unnecessary complexity. Complicated strategies often impress beginners, but ultimately distract investors from the core behaviors driving long-term success. Max avoided chasing trends because trends appear exciting but usually encourage buying high and selling low unintentionally. He focused instead on predictable growth engines like broad market index funds backed by decades of historical performance. Understanding risk allowed him to accept temporary downturns while maintaining trust in his long-term financial plan. Risk became manageable when balanced with bonds, diversification, and a disciplined rebalancing schedule supporting emotional stability. Max knew perfect timing was impossible, so he prioritized staying invested rather than predicting short-term outcomes. Time in the market consistently beats attempts to time the market because compounding thrives on long durations. Avoiding high-fee products became one of his strongest rules because fees silently drain wealth year after year. Lower fees keep more money invested, allowing the compounding engine to operate without unnecessary financial friction. Whenever offered complex financial products, Max asked direct questions, revealing whether they truly benefited his long-term goals. If an advisor hesitated to explain fees clearly, he treated that hesitation as an immediate warning sign. Transparency became non-negotiable because honesty supports trust, while secrecy often hides expensive disadvantages. Max frequently reviewed his accounts, ensuring nothing drifted too far from his chosen structure or risk tolerance. Regular check-ins prevented surprises and reinforced his sense of control over his long-term financial direction. He understood that small adjustments today prevent major corrections later, making financial maintenance easier and calmer. Savings grew consistently because he treated investing like paying a bill to his future self, without exceptions. That mindset made discipline sustainable because it transformed investing from optional to essential each month. Over years, those consistent contributions magnified into meaningful financial security that felt both rewarding and empowering. Max celebrated progress quietly with gratitude rather than broadcasting accomplishments that might encourage unnecessary comparisons. Quiet confidence replaced the desire for external validation, as wealth became a personal foundation rather than a performance. Max protected his mental peace by avoiding environments that encouraged reckless spending or status-chasing behavior. He recognized that happiness came from freedom, not consumption, especially when consumption only provided short-term satisfaction. Every financial decision became easier once he aligned spending with genuine values instead of impulsive desires. Aligning money with values transformed finances from stressful obligations into tools supporting meaningful life goals. Max intentionally kept his lifestyle simple, allowing flexibility during unpredictable life events without financial panic. This flexibility gave him confidence during recessions because his expenses remained manageable and never dictated his emotions. As his investments grew, he realized financial independence was not a distant dream, but an achievable outcome. Seeing consistent progress strengthened his patience because every chart confirmed long-term strategies outperform short-term reactions. Max continued teaching not for necessity but for passion, enjoying work without financial anxiety shaping his decisions. That freedom made his professional life more fulfilling because he pursued opportunities genuinely aligned with personal interests. Financial independence gave him space to prioritize relationships, health, creativity, and time previously consumed by stress. Max valued mornings without worry and evenings filled with peace knowing his future remained secure. Freedom became the true definition of wealth, far more valuable than cars, watches, or luxury experiences. Real wealth meant choosing how to spend each day without fear of unexpected bills ruining entire months. It meant spending time with family without constantly checking bank accounts for reassurance or financial survival. Max reflected often on how simple habits created outcomes that once seemed completely impossible for an average teacher. His journey proved wealth is built quietly through repeated actions rather than dramatic moments or lucky opportunities. He encouraged others to start even with small amounts because small amounts eventually create enormous transformations. Max emphasized progress over perfection because consistency always beats flawless execution in financial planning. He enjoyed teaching others about money using relatable examples, metaphors, and emotional insights learned firsthand. Sharing his knowledge made his journey even more meaningful because it empowered others to escape financial stress. Max believed financial education uplifted communities by reducing anxiety and increasing opportunities for long-term stability. His teachings reminded people that wealth is a skill, not a secret available only to high-income individuals. A skill can be learned, practiced, and improved, making financial independence more accessible than many assume. Max encouraged beginners to start small, automate contributions, and trust slow, steady compounding rather than chase excitement. He reassured them that emotional discipline develops gradually as investors experience downturns and witness predictable recoveries. Observing recoveries firsthand teaches lessons no book or lecture can fully convey about long-term market resilience. Max recommended keeping investing simple because complexity often hides unnecessary risks and confusing fee structures. Simple portfolios outperform complicated ones because simplicity encourages consistency, while complexity encourages mistakes. He avoided stock picking because it created emotional pressure and increased the likelihood of irrational impulsive trading. Instead, he trusted broad diversification to protect him from catastrophic mistakes and unpredictable market behavior. Diversification functioned like a team where weaknesses in one area were supported by strengths in another. This balance made downturns survivable and recoveries predictable without needing expert-level financial understanding. Max avoided debt whenever possible because debt limited freedom and restricted his ability to invest consistently. He paid off obligations strategically, ensuring interest never consumed resources better allocated toward growing wealth. Reducing debt lowered stress, which improved his emotional stability when making long-term investment decisions. Emotional clarity improved decision-making, which strengthened his overall financial strategy more than any flashy tactic. Max appreciated that financial health and mental health were deeply connected, influencing each other continuously. Feeling secure allowed him to pursue hobbies, travel, and spend quality time with friends and family comfortably. His financial freedom also created opportunities for generosity and community involvement, previously limited by tight budgets. Max discovered the joy of giving without fear, enriching both his life and the lives of people around him. He believed generosity strengthens communities and creates purpose beyond personal financial achievements. Living generously reminded him that wealth should improve life, not restrict it, or become an obsession. Max balanced enjoyment with responsibility through his fun fund, ensuring guilt-free spending aligned with personal happiness. This balance prevented burnout and made long-term financial discipline feel sustainable instead of exhausting. Financial independence gave Max options, and options created a life defined by intention rather than necessity. He woke up grateful for years of small, consistent habits that produced massive future benefits. Max frequently encouraged others to explore their own motivations for seeking wealth, because meaning matters deeply. Understanding purpose helps people remain committed during slow periods when progress seems invisible but continues growing. Purpose transforms sacrifice into investment because each small action supports a meaningful future outcome. Max often reflected on how little he needed to feel truly fulfilled once financial anxiety disappeared. Experiences became more important than possessions, as he valued memories far more than material items. Time replaced money as his most precious resource, shaping decisions with a long-term perspective. Max realized wealth ultimately buys control over time, not flashy displays meant to impress unfamiliar people. He encouraged viewers to question cultural expectations that equate spending with happiness or success. Happiness grows through relationships, freedom, purpose, and stability, rather than constant consumption. Max believed anyone could build a brighter financial future by applying calmness, consistency, and intentional habits. He challenged people to imagine what financial independence would allow them to experience or accomplish. That imagination becomes powerful motivation for building healthier money habits, starting immediately. Max reminded viewers that every journey begins with a single decision to take control of their finances. He hoped his story would inspire others to rethink their relationship with money and long-term security. He invited them to reflect aloud about what wealth means personally beyond common cultural definitions. Max encouraged conversations because open dialogue builds confidence and reduces societal financial anxiety. He believed shared experiences help people realize they are not alone in financial struggles or fears. Max ended with optimism, reminding viewers their future can transform through consistent small actions. He encouraged them to stay curious, stay disciplined, and trust the power of long-term financial growth. Max invited viewers to share their thoughts about freedom, happiness, and financial independence in the comments. He closed warmly, encouraging them to like, subscribe, and continue learning ways to build a stronger financial future.